Index Funds Explained. Top 10 picks for your future. What's going on, everyone? This is Money on the Go team. And look, I get it. The world of investing can seem like this big, scary monster, especially if you're just starting out. You hear all these terms like index funds, ETFs, diversification, and it can feel overwhelming. But honestly, building long-term wealth doesn't have to be complicated. In fact, one of the most powerful tools is also one of the simplest: index funds. Index funds are like the unsung heroes of the investment world. They're designed to track a specific market index like the S&P 500, and historically, the S&P 500 has returned an average of around 10% per year. In this video, we're diving deep into the world of index funds. We'll break down exactly what they are, how they work, and why they should matter to you. So, grab a notebook, buckle up, and let's get started.
All right, let's break down this whole index fund thing. Imagine a basket, but instead of fruit, it's filled with stocks from a bunch of different companies. That's basically what an index fund is. A basket of stocks that's designed to mimic a specific market index. Now, there are tons of different indexes out there, like the S&P 500, which tracks 500 of the largest US companies, or the NASDAQ 100, which focuses on tech companies. When you invest in an index fund, you're essentially buying a tiny piece of all those companies in the index. Think of it like buying a pizza instead of just a slice of pepperoni. With an index fund, you're getting a slice of everything, which helps spread out your risk. This is called diversification, and it's one of the biggest benefits of index fund investing. Instead of putting all your eggs in one basket, you're spreading your investment across hundreds, even thousands of companies. So in a nutshell, index funds offer a simple, low-cost way to invest in the stock market and participate in the growth of the overall economy.
You might be thinking, okay, index funds sound cool and all, but why should I actually care? Well, here's the thing. Index funds can be a total game changer for your financial future. First off, they take the guesswork out of investing. You don't need to be a Wall Street hotshot or spend hours researching individual stocks. With index funds, you're basically investing in the entire market, which historically has trended upwards over the long term. Second, index funds are incredibly low maintenance. You don't need to constantly monitor your portfolio or make frequent trades. Just set it and forget it. This makes them perfect for busy professionals, young investors just starting out, or anyone who wants a hands-off approach to growing their wealth. And finally, index funds have consistently outperformed actively managed funds over the long term. Index funds keep fees low and provide broad market exposure, making them a reliable choice for long-term growth.
Let's talk numbers, because when it comes to investing, seeing those digits grow is what it's all about. As I mentioned earlier, the S&P 500 has historically returned an average of around 10% per year. Imagine investing just $100 a month into an S&P 500 index fund starting at age 25. Assuming a 10% average annual return by the time you retire at 65, you could potentially have over $1.2 million. That's the magic of compound interest, where your money earns interest on top of interest year after year. Of course, market conditions fluctuate, and returns aren't always going to be that consistent. There will be ups and downs along the way. But by staying invested for the long haul and riding out those market fluctuations, you put yourself in a strong position to benefit from the overall upward trend of the market.
Okay, let's dive into the good stuff. The advantages of index fund investing. First and foremost, index funds are incredibly low cost. Because they passively track an index, they don't require a team of analysts to pick and choose stocks, which means lower expense ratios for you. Second, index funds are inherently diversified. When you buy an index fund, you're instantly invested in hundreds, even thousands of companies across various sectors and industries. This diversification helps mitigate risk and protect your portfolio from the ups and downs of individual stocks. Third, index funds are incredibly tax efficient. Because they have low turnover rates, they generate fewer taxable events, which can save you money come tax season. Fourth, index funds are simple and easy to understand. Just choose an index fund that aligns with your investment goals and risk tolerance, and you're good to go. Over the long term, they have consistently outperformed actively managed funds, making them a reliable choice for building wealth.
Now, let's be real. No investment is perfect, and index funds do have their downsides. First off, because index funds are designed to track the market, you'll never beat the market. You'll generally perform in line with the index you're tracking, minus any fees. Second, index funds can be a bit boring for some investors. If you enjoy researching individual stocks and trying to pick winners, index fund investing might not be the most exciting strategy for you. Third, index funds don't offer downside protection. When the market takes a dip, so do your index funds. This means you need to be prepared for market volatility and have a long-term investment horizon. Your financial goals and risk tolerance might require a more tailored approach than a broad market index fund can provide. With so many options to choose from, it can be tough to know where to start.
Alright, let's dive into my top index fund picks, starting with a real powerhouse, fund name and ticker. Now, this fund tracks the index tract, which is made up of brief description of index composition. What I love about this index fund is highlight key reasons for its potential. For example, provide specific examples supporting your reasoning. Based on my analysis and the current market conditions, I'm predicting that fund name and ticker has the potential to generate returns of estimated return range % over the next time frame. Always do your own research and consult with a professional before making any investment decisions. Moving on to my second pick, we have fund name and ticker. This index fund tracks the index tract, which focuses on brief description of index composition. What makes this fund stand out is highlight key reasons for its potential. For instance, provide specific examples supporting your reasoning. Looking at the current market trends and the fund's historical performance, I believe fund name and ticker has the potential to deliver returns in the range of estimated return range % over the next time frame. It's crucial to conduct your own due diligence and consult with a financial advisor before making any investment choices. Now for my third pick, we're going with fund name and ticker. This index fund tracks the index tract, which comprises brief description of index composition. What excites me about this fund is highlight key reasons for its potential. One compelling factor is provide specific examples supporting your reasoning. Considering the current market dynamics and the fund's past performance, I'm projecting that fund name and ticker could potentially generate returns between estimated return range % over the next time frame. Always do your own research and seek guidance from a qualified financial professional before making any investment decisions. My fourth pick is fund name and ticker. This index fund tracks the index tract, which consists of brief description of index composition. What sets this fund apart is highlight key reasons for its potential. One notable advantage is provide specific example, supporting your reasoning. Based on my analysis and the current market outlook, I believe fund name and ticker has the potential to deliver returns within the range of estimated return range % over the next time frame. It's essential to conduct your own thorough research and consult with a financial advisor before investing. And last but not least, my fifth pick is fund name and ticker. This index fund tracks the index tract, which includes brief description of index composition. What makes this fund compelling is highlight key reasons for its potential. One factor that stands out is provide specific examples supporting your reasoning. Taking into account the current market environment and the fund's historical performance, I'm forecasting that fund name and ticker could potentially generate returns in the range of estimated return range % over the next time frame. Always conduct your own due diligence and seek advice from a qualified financial professional before making any investment decisions.
So there you have it, a crash course on index funds and why they deserve a spot in your portfolio. Remember, index funds aren't about getting rich quick, they're about building wealth steadily over time. It's like planting a tree. You need to give it time to grow and weather a few storms before you can enjoy the shade. But before you go throwing all your money into any index fund, do your own research, understand your risk tolerance, and maybe even talk to a financial advisor. If you found this video helpful, hit that like button. Drop a comment below with your thoughts. And don't forget to subscribe for more videos on personal finance, investing, and building a life you love. I'll catch you in the next one. Peace.